Hey everyone, welcome back to Corporate Decoder, the place where we dig through the boring stuff so you don't have to. Today we are going to look at Brainstorm, sell Therapeutics, and whether their stock is a good investment after a roller coaster of regulatory hurdles and financial maneuvering. Let's see if we can decode what's really going on. If you like deep dives into companies, make sure you're subscribed. We also have a Discord community linked in the description below. Join in, it's great. This is Brainstorm Cell Therapeutics quarterly report, a Form 10Q for the period ended March 31, 2025. Basically, it's a snapshot of how they did financially in the first 3 months of the year. As always, this isn't investment advice, just a breakdown of the numbers. First, they include a special note about forward-looking statements. In plain English, they are warning you that everything they say about the future is just a guess, and a lot of things could happen to make those guesses wrong. It is important to remember that since investing is risky. Let's jump right into the numbers. As of March 31, 2025, they had about $1.6 million in cash and cash equivalents. That's up from about $187,000 at the end of last year, December 31, 2024. So they have significantly increased their cash. Now let's check their debts. Accounts payable are at $6.8 million, which is more than the $6.1 million at the end of last year. They are increasing their debts. Short-term loans are at $1.2 million, way up from $300,000 at the end of last year. So they are borrowing more short-term money to keep the lights on. Now onto how they're performing as a business. Their operating loss, the money they lost just from running the business, was about $3.1 million. It's important to note that they are a clinical stage company, which means they are still just burning cash and have no revenue to offset the losses. Their net loss, the total loss after taking everything into account, was $2.9 million. Now let's talk about how that compares to last year. Looking at last year, the net loss for the same period, the first 3 months of last year, was $3.4 million. So good news everyone, they are losing less money than last year. That boils down to a basic loss per share of 0.4435 versus $1.75 last year. It means they lost 45 cents for every share this year compared to losing 75 cents per share last year. Moving on to the statement of changes in equity. Basically, this is a history of all stock changes and issuance. It shows the company issued almost 2 million shares since the start of the year. Remember that these offerings dilute existing shareholders. Switching over to the cash flow statement, you can see that net cash used in operating activities was about $1.6 million, which is actually less than the $1 million used last year. The company also took out short-term loans worth $900,000 this year compared to $0 last year. The company received $1.5 million from warrants this year, whereas nothing last year. This shows they are using financial maneuvering to obtain more money, but does not necessarily mean their core business is better. The general section highlights a couple of really important things. First, the company needs to raise capital, but can't guarantee they'll be able to. Second, they've had operating losses for a while and expect to keep losing money. Third, this raises substantial doubt about their ability to continue as a going concern. The note goes on to mention that the company hasn't been keeping up with Nasdaq's listing rules, specifically the market value of listed securities requirement. They have until June 30, 2025 to get back in compliance, but there's no guarantee they'll be able to. The recent accounting standards highlights that their estimates might be wrong. Digging into other notes, note 5 regarding the stock capital talks about inducement agreement, warrants and other shares. I'm not a fan too much financial engineering going on here to cover business deficiencies. Note 6 discusses how fair value is measured, and they use a Black-Scholes model with volatility as an input. The higher the volatility, the less predictive a valuation is. Going to note 7 shows they have taken a bunch of short-term loans to stay afloat. This isn't very sustainable as a business model. The next major item worth noting is that they are being sued and have had derivative actions brought against the company. These suits are still pending, but they could get expensive. And of course, they remind you about all the risks that could sink the company, like not being able to raise money or the economy tanking. And the final item 5 is really interesting. None of the officers adopted, terminated, or modified a Rule 10b5-1. It basically means they have not set up an automated schedule to sell their shares. Overall, Brainstorm Cell Therapeutics is in a tough spot. They're still burning cash, they're piling on debt, and they're facing lawsuits. The only way that they're going to turn this around, and it's a long shot, is their drug works and they get regulatory approval. Right now, this is a company that has yet to prove that it can be financially self-sustaining. For me, that's too risky to invest in. Alright, that's our breakdown of Brainstorm Cell Therapeutics' latest filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments if this analysis was valuable. Hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.